So hey guys, welcome back to Accelerated Investor. I'm so excited to be with you again today. I have a special treat. I've invited my friend and my colleague, Daren Blomquist. He is the Vice President of Market Economics at auction.com, back onto the podcast yet again to talk about the trends in the marketplace. Daren, in his previous employment at Atom Data Solutions and his current job as VP of Market Economics at auction.com, does a phenomenal job of aggregating data, and you guys will love to hear some of the things that are going on in the marketplace. I'm sure you're wondering, what's going on with forbearances? What's going on with foreclosures? What's going on with home sales? What's going on with home prices? And all these things. Right now, it seems like the mainstream news is talking nothing except for the election and COVID. They're not really talking about the status of the actual real estate market. And oh, by the way, if they were talking about the status of the real estate market, they would be calling Daren anyway to interview him and his statistics and information to tell them what's going on with the market. He's been featured on CNBC, Fox News, CNN, and many major media outlets. We're excited to have him back yet again.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
Daren, thanks so much for joining me on Accelerated Investor. How are you?
I'm doing well. Yeah, I think we need something bad to happen in the housing market for them to start calling. Some more. That's when I was on most of those programs, is when the foreclosure crisis was at its height, and we were tracking foreclosures, of course. But the housing, we can jump into this, but the stuff that actually is being reported out there is mostly good news about the housing market. But I think there's certainly some stuff below the surface that creates some concern for the long term of the housing market and some opportunity as well. So that's the theme of what I put together for today, is this now and not yet idea, especially from the perspective of real estate investors. There are some opportunities now, but we actually see probably even bigger opportunities coming down the road because of all that's going on. And we'll get into that.
Phenomenal. Just to kind of debrief everybody, about 3 months ago, Daren came on. It was early April. We were kind of recapping what happened in the first quarter, maybe mid-April. And at that time, if you remember, we talked about this small example size of the hurricanes that hit in 2017 and them offering forbearance agreements and loan modifications in the New Jersey market, and how they were able to basically do a foreclosure moratorium for 9 months. And that became kind of the blueprint for COVID, for banks and the government to give people some forbearance agreements and eviction and mortgage moratorium. The difference is 3 years ago, it was this very small sample size of New Jersey, New York. Now it's the entire country. So we talked about that. We'll give you an update on that piece. The other thing we talked about back then was that demand was down significantly. It was down about 24% based off of Redfin, and Redfin basically tracks home buyers that are going on tours for the first time. That's kind of their definition of new buyer demand, versus supply, which was new home listings on the MLS with realtors, the National Association of Realtors. That was down about 55%. Now, that was right in the middle when COVID was really scary. Nobody knew what was going on with the disease. How catchy is it? What's the mortality rate? People were really afraid to leave their homes. 3 months later, The economy is starting to open back up. People are getting more comfortable with what the risk is, and they're moving back out. So Darren will definitely jump in and give us some updates on that as we go. So Darren, I want to kind of turn this over to you. I can bump through the slides. So just tell me like, hey, next slide, next slide, next slide. If you catch this on iTunes, we are going to have a corresponding YouTube video. So check this out on YouTube to make sure if you can actually see the slides that we're sharing. So Darren, where should we begin?
You can just move forward to the next slide. We'll start with some just high level macroeconomic trends, which are the unemployment rate. And I think this is, this provides a good theme for the housing market as well, is this idea that the short term versus the long term impact of this crisis that we're in. And really what is going to matter to most people and to the economy and to the housing market ultimately is the long term impacts. And there's just a lot of noise going on in the short term stuff. And you can see that here with the unemployment rate. The blue lines represent the overall unemployment rate. And there's two, not to confuse the issue, there's two lines depending on how you look at that unemployment rate, but they're going in the similar trend, which is huge spike and followed by actually some really good improvement in the June numbers and in the June unemployment numbers, and actually May as well. So you see this huge spike in April, and then an improvement in June, improvement in May, improvement in June. Off of that spike, and that's really more around the short term, the reopening happening then fairly quickly actually, and get a lot of people regaining their jobs. Now, there's a whole nother conversation about what we're going to see because of some of the slowdowns in the reopenings. But at the end of the day, it's that short term stuff is not as impactful because we have a lot of government intervention happening. Mm-hmm. And and the fact that it's short term, and what we're keeping our eye on in terms of our business, and I think that investors should ultimately keep their eye on, is that red line, which is a way of looking at unemployment that takes out all the temporary layoffs, and it also includes job seekers who maybe haven't searched because of the crisis but are would still be unemployed. And anyway, that core number is continuing to rise. It's not extremely high, but it is continuing to rise off of its lows prior to the pandemic. And that's ultimately what's going to drive distress in the housing market in terms of foreclosures, which of course is opportunity for investors. Right. So that's a theme. And I think, we'll continue that theme. If you go to the next slide, this short-term versus long-term piece, and it really comes into play because it's an election year, and I hate to get too, I don't want to get too much into politics, but it is having an impact because of all the push to try to not make things look as bad in the short term. And I think a lot of that good motivation. This is this unforeseen crisis that nobody anticipated, and so government policymakers are doing their best to say, hey, look, let's get people through that so we can get to the other side and pick up where we left off, type of idea. But the idea is a lot of effort and policy and political will being pushed toward making the short term not look so bad in terms of the impact of this crisis. The problem with, and this is data straight from Oxford Economics, this is not something I'm making up, but this is their headlines, trading short-term gain for long-run pain. Because of all this effort to make things look better in the short term and to ease the impact in the short term, they actually upwardly revised their GDP forecast, which the GDP numbers just came out yesterday, but they upwardly revise their GDP forecast to not be as severe as they originally had anticipated. But the trade-off there is that they see a bigger risk for this double dip scenario, that over the long term, you actually could see another dip in the GDP. And so that's a risk that they see increasing, even though in the short term, they're upwardly revising the numbers to not look as bad.
Yeah, the whole idea there for folks that don't understand double dips is obviously you pump the system full of surplus. I mean, not surplus, but stimulus, PPP money, stimulus checks, relief, all kinds of stuff for businesses and for regular citizens. And then businesses don't actually reopen their doors, or businesses don't actually have permanent job gain. And then that stimulus eventually wears off. The election is over November 3rd. I don't think any of us can hope that it comes fast enough so this can just get all behind us, and we can move on to a non-political year. And then all that wears off, and then all of a sudden none of it permanently takes hold. And then there's a new dip in GDP that goes back down. And that's a real risk, because depending on who's elected, depending on how long the stimulus lasts, you have that double dip scenario. So we'll see what happens there. Love to see the possibilities of which almost, it's nice to see them and all the options of which they're almost never exactly right, but it's nice to see the scenario of what could happen. I love to look at this, mortgage application volume. And I know this is already about 2 or 3 weeks old. You said there's some new information that just came out, but tell us about purchase applications and what it really means when people are applying for home mortgages and applying for refinances. What does that indicate?
Sure. Yeah, this is a measurement of demand. And I switched courses on you here. Last time I looked at a Redfin measurement of demand. This is actually probably a little more consistent data, and it's also weekly. So anyway, but if you look at those blue bars going negative, that was when we last talked in April. Demand was sinking, and by this, if you look at this just roughly, it was down as low as 35% in terms. And to answer your question, this is from the Mortgage Bankers Association. It's a survey of their members, their banks, and in terms of mortgage application volume, specifically for purchase mortgages. So these are people who are applying for a loan to buy a property. And so it's a somewhat forward-looking measurement of home sales down the road, and it's a measurement of how many people are interested in trying to buy a property. They're going to be making an offer because they're applying for a mortgage. And so that was way off, double digits, 35% at the bottom of this back in April. But then starting in mid-May, we started to see those numbers come up, and they've been up now for, actually there is another week's worth of data here that's not included, but it was up again for a 9th consecutive week. And refi is also up. The chart is not reflecting refi, but that's kind of a different market. This is looking at folks looking to buy properties. And so refis have skyrocketed, not surprisingly because of the low mortgage rates. This also is driven because of partially by the low mortgage rates, but also because people have regained some confidence in the economy and the housing market. So they're saying, yeah, we're going to go out and buy properties.
My newest and most powerful real estate investing book, The Flip System, is now available. And for a limited time, you can grab your free copy at getflipsystem.com/podcast. Using the same proven principles, secrets, and investing strategies I'm sharing in this book, I've been able to personally close over 750 highly profitable real estate deals over the last 15 years, make over 400 private lender loans, raise over $30 million of private money, and acquire over 2,000 units of apartments. Get my newest book now for free for a limited time at getflipsystem.com/podcast. That's getflipsystem.com/podcast. I know even my neighbor directly next door, big, beautiful luxury home, put the house on the market, sold over asking price in less than a day. And of course the house was beautiful. It's updated. It has checks all the boxes. But obviously somebody who moved in, who I'm getting to know, my new neighbor, was not afraid, right, to apply for a mortgage, buy a home, and invest in a new property right in the middle of COVID. So Matter of fact, I was blown away by how many houses or how many buyers were going through the house. Even on the first day, I think there were 12 showings, people in and out, in and out, in and out. And I thought, okay, like if you're a real buyer, if you're looking for a house, you're not afraid of COVID and walking through a property. That's starting to kind of wear off a little bit, and they just closed and moved in about a week ago. So, I definitely see people coming and going, and supply is still so low. It's snapped back, and we're going to talk about that next. But supply is still down overall relative to demand. And we saw a real lack of supply 30 to 60 days ago, which we talked about on the previous podcast. So tell us about that. How is home sales doing? Rebounding? How are home sales prices going?
Yes, so this is the NAR data on home sales and prices. And the graph on the left there is showing in May, there was a 27% drop year over year in the number of sales. So that is somewhat a reflection of the demand that we saw in April, but it's also a reflection of inventory. And I don't really have an inventory graph here, but supply was down around that as much as 50% range. Now, what it doesn't show here, and again, because this data is pretty volatile, in the June numbers, we saw a 22% increase month over month. I want to be clear on that, in existing home sales. So they did bounce back pretty strongly in June. And that makes sense given the rise in demand that we saw in the previous slide. So people are interested in buying. They actually are buying. Now they're not buying the demand. If you roughly compare the demand metric we just looked at, which is up year over year consistently for the last 9 weeks. On the home sales side, even though there was this 22% month over month increase in home sales were still down 11% year over year. And so that gives an indication that demand is stronger than supply. Demand is outstripping supply. And so more people want to buy than are actually able to buy. And that could be partially because of supply, partially because lending standards are still pretty tight. And so, but we are seeing that bounce back that doesn't show up on this graph in the sales. And then on the right side, you see the prices, and those have, a lot of people will jump on the theme that this is all supply driven, lack of supply driven. I would argue, based on the graph on the right, that there is, even though demand is coming back, there's something there that's preventing home prices from continuing to accelerate home price appreciation. So you see that home price appreciation drop to 2.3%, and that's the slowest home price appreciation we've seen from the NAR numbers since way back in February 2012. So, and that did actually, it ticked up a little bit to 3.5% in the June numbers, but it's still on the low side of what we had been seeing in terms of home price appreciation. And so I think a lot of this is lack of supply driven, but there's also some hindrances that are keeping home prices from accelerating, even though they are continuing to go up. But overall, when you look at this, you say, hey, the housing market is performing extremely well given the crisis that we're in.
Yeah, I'm excited to see what this looks like in a month or two from now. Obviously, this data trails a month or two. And we'll see how things go. But to see home sales units snapping back and home sale prices even going up even a little bit shows the resiliency of the market, the lack of supply. And also, I think the fact that over the last 8 years, as we've talked about on many previous calls with you, Darren, the number of institutional buyers that have bought tens of thousands of units and taken them off the market, essentially, turned them into rental properties, again, is another indicator of some overall lack of supply. If those institutions hadn't stepped into the market back in 2011, 2012, we would probably have way too much supply and the market would still be struggling. This next, I was looking at this particular slide when we were getting ready for the call, and looking at home price appreciation really happening. A lot of people think of home price appreciation happening near the city, near big cities. and people wanting to move to the urban core. That was the theme for years, people moving back into the city. And now, in Q2 2020, there was home price appreciation, but really the best places were that kind of mid-sized cities, mid-sized suburbs, the rural fringe areas. It seemed like home prices were appreciating more there than the, large city, inner core of large cities. And so is that an indicator of, people just wanting more space, wanting to move out in the fringe? Is it a matter of safety? Is it riots? I don't know. I'm interested to hear your take on it because there's so many crazy factors going on right now.
Yeah, I mean, we did this analysis based on the fact that a lot of people were saying anecdotally, yes, people want to get out of the cities, and there's a safety factor to that in terms of the health, the densely packed cities that may be more susceptible to the virus, and and also potentially the riots. So anyway, there was a lot of people out there anecdotally talking about that. So we just looked at the data, and actually we are seeing that happen in the data in terms of this home price appreciation, that demand is stronger outside of the large cities, in the suburbs, as you said, the mid-sized cities, the fringe rural areas, which are areas that are within 5 miles of an urbanized area, so they're not too far out. The rural remote areas are not performing very well, as you can see there at the bottom of the graph. So places that are way far out. So this does drive into that narrative, and I think this was really interesting to me, and I think it's a really key thing for real estate investors who are looking at where to invest. This could be a key kind of demographic trend that you look at, and I think it probably does have some legs. There's a little bit of a frenzy nature to it, a reactive nature to the virus and all of what's going on, but I'll talk more about this in the next slide. It's a continuation of a longer term trend that we've seen. So I think it does have some legs, but I just wanted to point out, we are seeing the right graph here shows that investors who are using auction.com to buy properties are responding to this, and they're showing more demand the way that we look at demand, which is a sales rate, the percentage of properties that are available for auction that actually end up selling. That sales rate is stronger in the suburbs and even the rural areas. And we actually see a slight decline on the online REO auctions in the cities for that sales rate. So investors are responding who are using our platform to that trend. And the next slide does show, this is going back to 2019 pre-COVID, that there are some elements of this move away from the big cities that were already in place. Now, it was for different reasons. It was for high taxes, and it was for weather potentially, and some things like that. So the blue here is states that people were moving away from. Net migration data from the Census Bureau. The orange is where people are moving to in 2019, and you see California and New York are some of the places that people were moving away from. And if you drill down to the county level there on the right, which, by the way, if you make this available, which I'm happy to your listeners, as they can click on this and actually go in on the right-hand side and see their county, what's happening there. But at the county level, it starts to get pretty interesting. You see, like in California, that all the coastal counties are orange, or most of the coastal counties are orange. But if you go inland a little bit, most of the coastal counties are blue, meaning they're losing population. Inland counties tend to be orange.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. Is that, you think, due to price, because the coastal counties are so expensive being on the ocean? Is it policy? Is it because they're all paying the same taxes? They're all in California, right? So it's got
so for within the place like California, it is affordability, the piece, and then although the higher the price, the higher tax. And I think that's the main driver there. But yeah, it's pretty interesting to look at the county level. In general, I think it is the fact that California is down is an indication of the combination of higher prices there and higher taxes, and possibly politics ties into that as well. But we saw the 2017 tax reform bill did hurt those higher price markets, because you take away some of the ability to deduct on your income taxes. There's a cap on how much you can deduct from state and local taxes on your federal taxes. So that negatively impacted some of those high price markets like California and New York. So all this to say that there's a trend happening, and I think some of the trend has been accelerated by the pandemic.
Yeah. You mentioned that our audience might be able to drill down into the county level. Just tell us how they would do that. What website would they go to? We'll also put that in the show notes too.
Yeah, I have a link here within the that you see there at the top, but I guess the best, it's a Tableau map. So if you do a Google search for Daren Blomquist Tableau, you'll see all my maps pop up there. And this is one of them, the more recent ones. And, but yeah, you can, that little link that's embedded there, Josh, you can feel free to share with, and yeah, maybe you can even bring it up on the screen here while we're talking, but see what's happening in Ohio.
Yeah, I actually do have it open. The screen I'm recording from is locked, but and I don't want to tinker with this too much just for the sake of time. But I am on my other screen tinkering with it. Nobody can see it, but yeah, I'll definitely play with this. And we'll put that link, that Tableau link, in the show notes, so everybody can check that out. And when we email out this invite to our followers and our students, we'll include that Tableau link right in the body of the email as well. So next slide talks about delinquency, and this is becoming a hot button for a lot of people. I'm starting to see more and more email copy from some of my friends who are affiliates, who are speakers and trainers, talking about there's going to be opportunity. They're starting to see, that forbearances are spiking, obviously. Delinquencies are spiking. And there's going to be a percentage of these folks, very similar to the hurricane data, that don't make it out, that don't come back current. So let's just explain this, what we're looking at here. And then based on our previous conversation about the hurricanes, what is some potential outcomes maybe a year from now from all these delinquencies? So just kind of explain the graph and then help interpret what does the future look like based on this data?
Sure. Yeah, this is data from Black Knight, and they actually just had new data come out yesterday that did fall in line with what I kind of predict here, which is that middle bullet, 90-day delinquencies will likely spike in June. Their June data did show the 90-day delinquency spiked. So what we're looking at is, it's not a delinquency rate, it's actually a number of people who are delinquent in the bars there, and it's broken out by 30 days delinquent, 60 days, 90 days. 90 days is the red. You see the spike in the 30 days right away there in April. So a lot of those folks going into forbearance were not making their payments. And so you saw the spike that was higher than any single month going back in the Great Recession in terms of the number of people who went delinquent. And then the next month, you saw the same thing happen with the kind of gray bar there, which is the 60 days delinquent, went higher than any level back, or at least higher than most months going back, as far as I can see, in the Great Recession. And then we expected that to cascade through, and it did. In June, we saw the number of, according to this data, the number of the 90-day delinquencies jump triple from May to June. And they said on the call yesterday, they're expecting those 90 days to peak potentially unless there's this double dip scenario. And they actually, it's funny, they mentioned in the call that this is shaping up to look a lot like the hurricanes. So to your point, this rapid spike in delinquencies, especially when you have a forbearance program as a kind of a safety net for folks, people are using that safety net, and there's this very rapid ramp up in delinquencies. And the shape that, if you overlay the shape of that curve to the shape of the curve during some of the previous hurricanes over the last few years, it looks very similar. Now, the big question is, will this behave like the hurricanes as we get out of it? And that's harder to determine. I mean, if it does, the best case scenario is it does, and you end up with the performance there is about 5% of the properties that went into forbearance and / delinquent ended up at foreclosure, being foreclosed on, 1 to 5%. So it's a pretty low number. I would suspect, my personal opinion is you're going to see higher than that with this. This is a more widespread, it's not regionally, and so it's affecting the economy as a whole, not just one local area. And potentially also it's going to be more long lasting.
And you've got job loss of all these companies that have filed for bankruptcy. So major companies, right? Pier 1, J. Crew, Victoria's Secret, their UK division, Hertz Rental Car, Chesapeake Bay Energy. That doesn't happen in a hurricane, right? That's a short-term loss. There's typically not major companies that go bankrupt because of a hurricane. Because of COVID, you've actually seen significant number of companies go flat out bankrupt. Some of them will never come back. That's an element of the wider spread problem of COVID versus a very small potential problem. And I hate to say small, but it's a very regional problem with a hurricane. So that is, I think, where, like you talked about, the data being different on the outcome is that in the short term, we're delaying the pain, and eventually those properties will end up in some state of either refinance, sale, or foreclosure due to non-payment when the moratoriums are lifted and the forbearance agreements don't last anymore. The problem is then will those folks have a job to go to reinstate their loan? And it's just a wider spread problem now than with a very regional hurricane. So I do anticipate, people are asking me, like, do you think this is going to be 2008, 9, 10? I said, no, I personally don't feel like it is. I think it's going to be a smaller version of that. And I also don't think it's going to last like the 2008, 9, 10. It took so long for people to figure out what the hell was going on. That lasted almost all the way into 2015, 16. It was about a 7-year problem. This is going to be something that I don't think lasts nearly as long. I think we're well more equipped and prepared to deal with this because we just went through the recession 10 years ago. People realize what were the policies that worked, what are the policies that didn't work versus in 2008. I hate to say it this way, but we all got caught with our pants down. Nobody knew what was going on. And so we were very reactive. This time we're very proactive. And I think that's going to help.
I couldn't have said it better myself. I totally agree with everything you just said there. Well, yeah, that's an image I don't want. I agree. And I think the bias I have is that I think servicers and policymakers seeing that proactive forbearance programs worked very well in the hurricanes. And this is not a hurricane, but the more that they can follow that route, the better. What I don't think worked well when we got caught with our pants down was just the blanket foreclosure moratoriums that just delayed everything. And that just created more uncertainty and also more of an backlog of foreclosures that eventually had to come out. In the state, they won't throw the baby out with the bathwater, whatever analogy you want to use, that the forbearance programs work very well to protect people from unnecessary foreclosure without creating this uncertainty and shadow inventory in the market that ends up hurting the market and making the pain last longer than it really needs to.
Hey, listen, so I hope you enjoyed this discussion with Daren Blomquist, VP of Market Economics at auction.com. Please go visit their website, auction.com. Jump on, log in, and use their platform to acquire properties. Again, there's over 3,000 foreclosures that are typically processed, and over 1,500 a week are actually sold on the auction.com platform. It's a fantastic tool. So I hope you enjoyed this conversation with Daren and I. Don't forget, we are also going to be releasing part 2 of this conversation. If you enjoyed it, leave us a 5-star review, leave us a rating. We'll send you a free t-shirt. Also, don't forget a copy of our free book, The Flip System. You can get it for free at getflipsystem.com. Get it absolutely free. Just pay the shipping and handling. We'll send it out to you. Auction.com is one of the tools that I talk about in the book as a way to acquire great deals at huge discounts. Thanks for joining me today on Accelerated Investor. Hey, Josh here, and do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes, okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're gonna do then is every week we're gonna pick our favorite rating and review, and we're gonna send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.